Hi guys, welcome back to Father and Son Investing. This is a continuation of our series on bonds. The first video that I did talked about 4 principles that you can use to go about selecting which type of bonds or bond ETFs you might be interested in. I'll leave a link to that video at the end of this video. The next video that I did talked about long-term treasury bonds like TLT and EDV because I saw some potential, a chance to make some money there that hasn't actually worked out since the Fed has cut rates. The interest rates or the yields on U.S. Treasuries have gone up on that long end of the spectrum, and thus TLT and EDV, their prices have gone down. Today's video is going to be talking about corporate bonds. Corporate bonds, we're going to talk about the advantages of corporate bonds in this video. In the next video, I'll do the disadvantages of corporate bonds. I'll follow that with the similar topics for bond ETFs, bond funds, corporate bond funds. We'll talk about the advantages and then the disadvantages. So it'll be 4 shorter videos rather than one long video on this topic. So let's get started. Before we get into corporate bonds, let's just have a quick basic discussion on bonds. For those of you who are not familiar with bonds, you can think of a bond as a loan. Essentially, you are loaning your money, in this case, to a corporation. In return for that loan, that corporation promises to pay you a certain amount of interest annually. So that is what a bond is. You're essentially making a loan. Now that interest payment that they make is called a coupon, C-O-U-P-O-N. Some people could pronounce that coupon, but we'll call it coupon on here. So the coupon is the actual payment, the money that you receive back from the corporation that you loaned your money to. Now, there are some type of bonds out there that are called zero coupon bonds. In that case, you don't actually receive an annual or monthly or quarterly payment. What happens is you receive your interest at the end of the term of the bond when it matures. So those type of bonds, zero coupon bonds, are sold at a discount. For instance, if you're going to receive $1,000 in 2 years, it's a 2-year zero coupon bond, you may pay $800 for that. Therefore, you're buying this bond at a discount, and the interest essentially that you would receive for loaning your money to this corporation would be the $200 difference between the $800 and $1,000. Lastly, let's just quickly discuss yield to maturity. This is what you can use to compare one bond to another. The yield to maturity is essentially the total return anticipated on a bond if the bond is held until it matures. Now, the coupon payment is always the same. That never changes. But the yield to maturity on a bond might change depending on what the price of the bond is if you are buying and selling a bond on the secondary market. There is certainly much more to know about bonds. However, this will get you started with some of the basics. Now let's talk about the advantages of corporate bonds. Different people may see different things as advantages or disadvantages. I'm going to list 4 things for you that I see as advantages of corporate bonds. The first advantage that I see in corporate bonds, these are investment grade corporate bonds, is regular income. You may be thinking, well, yes, but U.S. Treasuries also offer you regular income. But the advantage here of a corporate bond is that you're getting a little bit extra regular income. That's called the spread, the difference between what a U.S. Treasury yields and what a corporate bond yields for similar levels of maturity or dates to maturity. I wanted to show you a graph from a recent Financial Times article showing what these spreads have looked like over the years. You can see that back here in the early part of this century, the spread on corporate bonds versus U.S. government bonds was significantly higher than it currently is. Can you imagine getting 6% extra on a corporate bond? If we look at the spread on corporate bonds now, you will see that it's the smallest it has been since March of 2005, according to this Financial Times article. So that is advantage number 1 that I see: regular income from a bond, a little extra regular income from a corporate bond compared to a U.S. government treasury. Let's talk about advantage number 2. Advantage number 2 of a corporate bond, and really any investment grade bond, including U.S. Treasuries, is capital preservation. If you hold your bond to maturity, you won't lose money. Now, if you need to sell your bond before it matures, you may either lose money if the price of that bond has gone down, or you may see a capital gain or an increase in money when you sell if the price of that bond has gone up. What makes bond prices go up or down? It has to do with interest rates. If interest rates go up, bond prices go down, and vice versa. The third advantage that I want to talk about for corporate bonds is stability. During times of stock market fluctuations or instability, people tend to run toward the bond market. That bond market in general has been much more stable or sees fewer fluctuations than the stock market. The last advantage when it comes to corporate bonds is security. I'm talking about investment grade corporate bonds. In fact, let's touch on this quickly. There are 3 ratings institutions in the United States who grade bonds according to their default risk. Now, those 3 institutions are Moody's, Standard & Poor's, and Fitch. I like the Standard & Poor's and the Fitch because I think it's a little bit easier to remember and to understand. It's based on grades really going A to D. Triple A means extremely low risk of default. Those are high investment grade bonds. The cutoff for investment grade is BBB minus in both the Standard & Poor's and the Fitch ratings. Now, the Moody's scale is a little bit more confusing to me because they start bringing in some numbers in there and they include B's with A's, and I find that confusing. Nevertheless, if you're looking for investment grade, the cutoff is Baa3 when it comes to the Moody's rating system. So those are the 4 advantages that I see for you when it comes to corporate bonds. Regular income, a steady stream that you can count on. We're talking about investment grade bonds. Then capital preservation. You buy a bond for $1,000. You're going to get that $1,000 back pretty much assuredly if you are in investment grade corporate bonds. Then we talked about stability. When markets are fluctuating, bond markets tend to fluctuate less than the stock market. And finally, security. Your risk really of default when you're in investment grade bonds is minimal. So you may have other advantages that you can think of for corporate bonds. If you do, leave those in the comments. Right after this video, I'm going to go ahead and make the video for disadvantages of corporate bonds. That list is going to be significantly longer than this short advantages list. Until next time, enjoy your investing.